In this episode, I continue with part 2 of my interview with Joseph, the founder of the popular YouTube channel, Let's Talk Money. Joseph talks about how he's investing in today's economic climate and where he thinks the market is headed in the next 12 to 24 months. Joseph is a veteran of the Marine Corps, holds the Chartered Financial Analyst designation, CFA, and has appeared on CNBC, Bloomberg, and Fox Business. Hi, my name is Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. Let's continue with part 2 of my wide-ranging interview with Joseph. Now, we talked earlier very briefly about dividend growth, the company increasing its dividend every year. And you had a really good point in one of your recent videos, probably the same one I'm looking at here, the 5 safest dividend stocks. Can you tell our audience what is a dividend aristocrat and what is a dividend king?
Oh, sure. Yeah, great. Two great groups, really kind of measured on how long they've paid out those dividends, as well as, if they're a part of an index. So the dividend kings are companies that have increased their dividend for 50 plus years, right? So obviously much fewer. There's only, I think, 47 dividend kings right now, companies that have increased their dividend payment for that many years. No other requirements though in that group, and no funds. So I was kind of surprised actually last time I looked at it that there are no funds, no ETFs that invest in the dividend kings. The dividend aristocrats though is 25 years plus of increasing payments. So there's more companies there. I want to say something like 67 companies in the dividend aristocrats. But besides that requirement for consecutive years of dividend increases, 25 plus, then they also have to be a member of the S&P 500 index, which is the 500 largest companies in the United States. So not only are they have they that commitment to shareholder cash return, but they're also very large, very stable companies. Companies with the financial flexibility to, well, not only to grow those dividends, but to survive pretty much any kind of economic recession.
That's an impressive track record.
It is.
It's one of the things that I constantly hear, especially from folks who are not dividend investors. They'll say things to me like, well, the dividend isn't guaranteed. Companies can reduce the dividend. They can eliminate it. There's no legal obligation for a company to pay you a dividend. So then as a dividend investor, how do you have any confidence investing in dividend stocks?
Sure. Well, you just have to look at that history, that commitment and history of dividend increases, not only paying the dividend, but dividend increases. And to say that the dividend kings don't have any other requirement. Any company with a 50 plus years of dividend increases, it's going to be a fairly stable, mature company with a lot of financial flexibility, more often than not. But yeah, you look at the dividend history of no cuts, dividend increases, things like that. You look for the payout ratio, but also you also want to just spread your risk around, right? What I recommend to all investors is 50-60% of your money in ETFs, in funds, and then if you want to invest in individual stocks, and nobody has to invest in individual stocks. You could hold just 3 to 5 ETFs or funds and be just fine. But if you want to invest in ETFs that have maybe 30% of your portfolio in those individual stocks, but if you're investing the majority of your money in those individual or in those portfolios or those ETFs, like the Noble, the NOBL, the Dividend Aristocrats ETF, like maybe the Schwab Equity Income ETF, which is SCHD, another really great income or dividend ETF, then you're getting hundreds of companies in that fund that are paying dividends. If anyone has some kind of bad news and falls, it's not going to destroy the ETF. It's not going to destroy your portfolio. So really, you're spreading your risk out across hundreds of companies in those, or dozens in the case of the NOBL.
Yeah, no, that's those are all good points. So as of this recording, because this episode is going to go out a little later when we publish it, but as of this recording, there's been some recently bad news. So a couple of days ago, I'm going to talk about, to say the least, Silicon Valley Bank is gone. As of this morning, the Signature Bank in New York also has been taken over by the feds. I'm assuming they've shut it down. So those are all, that's drastic, right? Those are like I think I read the headline was the third or largest bank in the U.S. to go down.
Second and third. Yeah, second and third, right? The
second and third.
SVB was the second largest bank failure in the U.S. history, and then Signature was the third. And yeah.
And now we combine that with what we saw last year with the interest rates going up, right? We may have more increases this year. We may not. I don't know. But we've certainly, looking back the last 12 months, we've had increases in the U.S. and in Canada. Inflation's running at around 6 to 7%. So that's high. And the Federal Reserve is doing what they can to bring it down. When people read that in the news and they hear it in the news, it scares them. So what advice would you have to someone who's just starting out, right? Who just maybe graduated 2, 3, 4 years ago, is working, has got a day job. What advice would you give to someone who's just starting out? Would you tell them not to invest? Or what would you tell them to do if they wanted to get into investing?
Well, of course not. Just to avoid investing altogether. One is, remember, you don't have to pick individual stocks. In fact, 99% of the people out there, they would be just fine without individual stocks. If you want to invest in individual stocks, but you feel a little uncomfortable, feel a little uncertain about picking stocks, just get started in those ETFs, right? Invest in those broad funds, whether it's an index fund or a strategy fund, like a dividend ETF or something like that. Start investing in those. That's going to give you the time. Your money's going to be working for you. You're going to be earning those dividends that you can reinvest in the funds as well. But that's going to give you time to learn about investing, learn whether you even want to pick individual stocks, things like that. Second is, especially for the investors right now, look at any stock chart. Look at any stock chart, the S&P 500 over the last 50, 60, 100 years. And the one thing that is guaranteed is that stocks will eventually go up again. Okay. There's nothing new under the sun, right? The stocks will go up. We will have stock market crashes over the next 10, 20 years, but stocks will go up and they will make you a lot of money. Third, final point there for that is just understand that now is the best time to invest. Okay, you make your best investments, you make your best money and best returns when stocks are crashing. And there's all kinds of euphemisms like when there's blood in the streets, or be greedy when others are fearful. But all you have to do is look at it. And when are you getting the best prices? When do you know you're getting a discount to stock prices? And that is when stocks are crashing. Okay, the best analogy or best example I always love giving is Amazon, right? Amazon IPO'd in 97, I want to say eventually reached up to about $100 a share by late 99, early 2000. And of course, we know what happened. Crashed down to $6 a share on an unadjusted basis, right? I know they had a split not too long ago. So on a split adjusted basis, that stock was just 47 cents each at its low in 2002. And now it is upwards right around $100. So, if you had that intestinal fortitude, the guts to stick with that stock in 2002 when it was trading at 50 cents a share, now you would have 200 times your money. And at one point, it was up to $3,000 a share pre-split. Before the sell-off over the last year, it was up like 500 times your money. Right. So imagine that $1,000 investment in Amazon 2002 would be worth $500,000. Just one investment, $1,000, $500,000. But you have to understand that when everyone's selling out, when everyone's screaming that their portfolio is going nowhere and taking their money out, you have to keep on investing.
So that's easier said than done.
It is, of course.
So what do you think? What are some of the attributes that an individual has to have to invest, whether it's even in ETFs or individual stocks?
Sure.
What are some attributes that you need to be able to do this?
Well, I think saying that somebody doesn't have the attributes or shouldn't invest at all is almost ridiculous. I can't imagine anybody that shouldn't invest their money or shouldn't try to make their money work for you. Because as we talked about, if you're not an owner of assets, if you don't own a share of those companies through a stock, then you're always working for your money. When you stop working, you stop making money. This is the only way to besides creating your own business, which is also something that a lot of people should do. This is the only way, though, to put that money to work for you, not have any other responsibility, in managing a business or doing anything after that, and still have your money working for you and still be making money. So I don't think there's any attributes that somebody would lack that would mean they shouldn't invest at all. One that would separate the people from investing just in ETFs and investing in individual stocks. I think they have to have that risk tolerance. They have to be able to see their portfolio fall 5 or 10 or 20% and not lose sleep over it, not have it scare them so much that they take money out or sell those stocks, right? If you can't kind of disassociate yourself from the stock market and not worry too much about it, then you really do need to just invest in ETFs, right? Don't worry about it. Just invest in those large funds. Maybe even use a robo-advisor that is going to do your investing for you, and just don't worry about it. Do what you do best, and again, I love talking about stocks, talking about individual stocks and buying stocks. But for 90% of the people out there, just don't worry about it. Just put your money in funds, put your money in a robo-advisor or with an advisor, whatever you want to do. Don't worry about it. Do what you do best. Earn money the way you earn money, and let the stock market do its job, and making you money and making your money work for you. So I think that's probably one of the only things that I would say would separate someone from whether they invest in individual stocks or just ETFs, just kind of a passive investing strategy, which is basically just putting your money in something, never doing anything with it, never worrying about it, only even looking at it once a year.
Yeah, absolutely. You got it. At the end of the day, you have to be able to sleep at night with your investments. And if you're going to be panicking all the time because your stock went from $25 a share to 20, and you're just stressed out all the time.
I would add one other kind of attribute, and I think it's an important one that nobody talks about is if you're going to be picking individual stocks and following your portfolio and watching YouTube channels and things like that, you got to enjoy it, right? You have to get something out of it besides the returns, besides the extra money, right? Because when it comes down to it, and I'm fine with saying this, picking individual stocks, if you're very lucky and very good, you might make 1 or 2% more than the overall market. Okay. Even huge, even $1 million hedge fund, analysts, even equity analysts, barely able to beat the market index or their indexes, their benchmarks on a regular basis, if at all. Right. So if you're not enjoying picking individual stocks, if you're not enjoying watching your investments and managing those yourselves, then, a lot of times it's just not worth it, right? If you're spending, think about it this way. If you're spending 10 hours a week watching the stock market, following your stocks, trying to pick other stocks, that is that is time that you could be spending making money and just investing that in an ETF or broadly across the stock market and not having to worry about anything, right? If you make $20-30 an hour, it's an extra $200 or $300 a week that you could just be investing, not worrying about it, right? So you have to be able to get something out of this beyond just the returns. If you're not getting that something out of it, just invest in an ETF and don't worry about it.
Yeah, absolutely. I always tell people you have to have the patience because it's not something you can get in and out of in 3 months or 6 months. You're in it for the long haul. We're talking, when I look at my investments, I'm looking at 10, 15, 20, 30 years down the road. So I'm holding them for a very long time. And like you said, if you don't have that kind of those attributes, or if you might be just better off with the ETF. Now, the only thing with the ETF, as you know, I'm an individual stock investor, and that's all I invest in. With ETFs, you just be aware of the fees. So you want to stick with the ones where the fees are going to be lower, right?
Sure,
because the fees do add up.
Yeah. I would say, I would be hard pressed to invest in any ETF with a fee with an expense ratio of over 0.5%, right? 0.5%. And the vast majority of cases, you should not be paying more than 0.2%. So 0.1% for an ETF. I mean, there are plenty of funds by Fidelity, by Vanguard that charge even less than 0.1%, which yes, over 20, 30 years, it'll add up. But I think it's a fairly low fee to pay for that kind of diversification, that kind of risk reduction, and really not even have to worry about your investments.
Yeah, and that's good for the audience to know because 0.5%, and like you said, stick with less than that because even 0.5%, which doesn't sound like a lot, $500,000 invested in there within a rate of return of, we'll take an average of 8%, let's say, over 20 years will cost you $206,000 in fees.
Yeah.
which is a huge chunk of your original $500,000 investment. So yeah, stick with the lower fees. The lower, the better when it comes to the management expense ratio. Okay, so you talked about share buybacks. Why are those important to me as a shareholder? What do I care if the company is going to be buying back their shares? How does that benefit me?
Sure. Well, in a sense, these are the same as dividends, right? Is the company taking some of its earnings and instead of reinvesting those earnings, those profits into growth for the company, it is returning that in some form of shareholder cash return, right? With a dividend, it's obviously just sending the cash your way into your brokerage account. With a share buyback, it's using that cash to take those shares off the market. So, of course, with fewer shares on the market, then you have a bigger slice of the pie of that company, right? You own a bigger percentage of that company, and you own a bigger percentage of those future earnings, right? So, as those share buybacks get instituted, you own more earnings, and the share price should go up, right? So whereas a dividend will detract from the share price, right? Theoretically, the share price should go down after a dividend is paid because that is less earnings the company has. A share buyback should have the stock price go up, right? So it's just whether you want your money now or in the future or a combination of both, right? So it's also important as that kind of cash discipline idea, right? If a company does have a share buyback program, they've committed a certain amount of cash to buy back those shares. They know they can't go after all those or vanity projects that they want to invest in. Maybe can't acquire any company that they want to because they have that commitment to shareholder cash return by buying back the shares. So it's a little bit of a discipline, cash discipline as well.
Okay, yeah, that's good to know. So it's going to be better. It's going to be good for me, the shareholder.
Oh, right? Definitely. Yeah, definitely. Yeah, and whether it's whether it's better or worse than a dividend is really kind of, six of one, half dozen of the other, right? If you need that income or you need those dividends, then obviously you're going to prefer dividends. But again, if they're buying back shares, then the share price should be going up, and you can just sell some of those shares, pay the capital gains tax on those instead of the dividend tax. Then and it's basically almost the same thing.
Mm-hmm. Now, so you've been investing for a while. We talked about that in the beginning. It's been many years.
Yeah.
Have you changed your approach based on what is happening today in the current economic climate, or are you just investing the same way you were like 5-6 years ago?
Okay. I've definitely changed my approach since I started investing, right? When I started investing in 1999 and for years after that, I was what you see with a lot of new investors, only going after those growth stocks and wanting to get rich immediately, or I'd be momentum investing, right? Investing only in the stocks that are going up because they must always be going up, right? And so I've gradually shifted, I guess, to investing in dividend stocks, investing in more stable companies, longer term investing, things like that. So definitely that. Over the last couple of years, I would say, over the last 2 years, I've certainly shifted to holding more cash, more protecting my money a little bit more, maybe investing a little bit more in those dividend stocks versus the growth stocks. There in 2021, we were just seeing just ridiculous valuations in those growth stocks, growth stocks trading at 10 and 20 and 30 times on a price to sales basis, and unprofitable companies, right? So it's times like that where, it's clear that a bubble is forming in the stock market, and you really need to kind of adjust your allocations in your portfolio to a little bit more dividends, maybe value stocks, and more cash, right? I'm currently sitting on about 20% of my portfolio in cash. Just waiting for some of this volatility to come down. I've got a lot invested in, treasury bill ladders, things like that are paying me that, 5% return, annualized return. That's still flexible enough that I can take money out and put it in stocks when I feel like the time is right.
Okay. So this might be a difficult question to answer, but where do you think the market's headed in the next 12 to 24 months?
Sure. And of course, that's the $1 million question, right? Or the $1 billion question, because anybody that can answer it well, I'm sure they would be a billionaire. I mean, you can't tell from month to month, but there's just a few things that we know, right? We know that the Fed has raised interest rates at the fastest pace in 40 years, Okay, we know that stocks and the economy typically, or the economy anyway, typically takes at least 6 months to adjust to interest rate increases. So we know that the economy has not slowed down yet to the point to reflect all these interest rate hikes, right? The interest rates are just the cost of doing business, cost of borrowing, for businesses, cost of doing business, cost of borrowing for people, mortgage rates. So, as those interest rates get reflected in the economy, you're going to see a slowdown. Okay, we know that we have 3 straight quarters of earnings declines, right? We've already gone through the fourth quarter, 2022. Earnings for S&P 500 companies fell about, I think it was like 5.6%. Their analysts are expecting 2 more quarters, first quarter and second quarter of this year, 2023, to be consecutive earnings declines for companies in the index, right? So we're going to see 3 quarters where companies are saying, hey, look, on a year-over-year basis, our profits are falling. Okay, so if you think about that, what are stocks? Stocks are an ownership of those earnings. If you're getting less earnings and those earnings prospects are going down, then stock prices have to adjust down lower as well. We've never seen the kind of increase in unemployment that we're going to be looking at. The Fed itself is targeting at least a 0.9% increase in unemployment through those rate hikes, right, to slow down the economy, to slow down inflation. We have never seen more than about a 0.6% increase in unemployment without a recession. Right. So I think, and we know, research by Deloitte shows that the average recession drops about 10% off of corporate earnings. Right. So if you just look at the numbers, S&P 500 companies reported about $219 in aggregate earnings per share last year, 2022. They're expecting, analysts are expecting about $223 in per share earnings this year. Okay, that's about a 2% increase. How do you get that with a recession? A recession, that's going to knock those down to about $210 in per share earnings for the S&P 500. Market trading right around 3,900 right now. That's still about 18 times on a price to earnings basis, which is not cheap. A lot of investors looking over the last year, stocks have come down, think that stocks are cheap right now. They're not. Stocks are not cheap. So you kind of do the math and you say, okay, when would I be comfortable investing in the market? And if you look at the PE history of the market, 16 and a half, 16, 15 has always been a very good time to wait. So I am, I've got a third of my money waiting for 3,800 on the S&P 500, another third waiting for 3,500 on the S&P 500. That would be right at that October low that we saw last year in the market. And then, even keeping a third of it for the low case scenario, maybe about 32 or 3,300 on the S&P 500. It's at those points. I'm not saying that stocks might not fall further, but it's at those points where I'm saying, okay, you know what? If earnings are right around $210 a share for the S&P 500, if it gets down to 3,500 on that basis, that's 16 and a half times on a price to earnings basis. I would be comfortable even if stocks came down a little bit. I bought in at that price, and over the long term, I know I'm going to get a good deal. I know I'm going to get a good return. So that's just kind of what I'm looking for. The thought process I'm using to say, okay, when do I want to wait to reinvest some of this money?
That's great. That now it makes sense when you said you were sitting on 20% cash, right?
Yep.
Because of what is about to come. And
Sure.
on what you've given us, the numbers, it sure looks like we're headed in that direction.
Oh, sure. We've still got probably, the market is expecting about 3 more Fed rate hikes from the Fed. Okay. Of course, who knows how they'll react to this SVB banking crisis. But if you just look at the CME FedWatch rate tool, which kind of shows you the market odds or probabilities of different interest rate increases, we're looking at 3 more rate increases, upwards of about 5.5, 5.7 on the Fed funds rate. That would be, about 0.75% to a whole 1% higher than where we are now. So we're still expecting the Fed to continue raising interest rates. We're seeing that inflation is stubbornly high and persistent. So it's not coming down as fast as the Fed would like. So even in light of this banking crisis, the Fed has got to stay vigilant against inflation and raising those rates, and that is just going to further slow down the economy. So I think a lot of investors are still delusional that we're not going to get a recession, and that's supporting stocks. I think there's more pain to come for the stock market, and that's those are kind of the levels I'm looking at to have confidence in where I want to invest.
Yep, and that's why we talked about this before. You want to invest for the long term, right? You
Definitely.
want to think 10, 15, 20 years down the road. Like you said before, In the long term, when you look at the stock market, it does.
It's going to be higher. Sure.
But in the short term, it's kind of doing this, and we're kind of in the middle of it right now, and who knows where it's going to go. Okay, we got just a couple of more minutes left. I wanted to ask you if is there any dividend stock that looks interesting to you right now?
Okay. I really like MPW. That's Medical Properties Trust. It has gotten hammered over the last year. It is a real estate investment trust. So they own the hospitals and the real estate on which those hospitals are built, right? They typically do a lease buyback, triple net lease kind of idea. So they'll look for hospitals that are privately owned or medical facilities. They'll buy the hospital, buy the real estate, and then lease it back to, that hospital or that provider, right? If you look at the long-term demand for healthcare properties, very strong, right? So those are good real estate properties. Right now, real estate just got slammed last year anyway, right? With that fastest rate increase in 40 years, rates from 0 to basically 5% on the Fed funds rate, mortgage rates and commercial property rates even higher. And real estate is very much highly leveraged. So all real estate fell, those real estate investment trusts, the sector fell like 26% last year, something like that. But MPW and healthcare REITs even further because the reimbursements from Medicare, from insurers haven't really kept up with inflation, right? So we're seeing a lot of problems with healthcare providers, facilities, hospitals, things like that, and some insolvency, right? So investors are very worried about those healthcare properties, things like that. But if you look longer term, again, the demand for healthcare properties is very strong. The Medical Properties Trust, ticker MPW, management in its quarterly report estimated about $1.57 kind of midpoint in FFO. That's a funds from operations. And again, that's the coverage ratio you need to use for real estate investment trust is that FFO. So if you look at that $1.57 in FFO, the $1.16 in dividends, then it's about a 45% coverage ratio, right? 45, 55%, and easily covered, right? I think the stock is trading like there's going to be a dividend cut, but there's really no reason to cut that dividend with that kind of funds from operations. So it's something like 11.5, 12% dividend yield right now. Very strong long-term price appreciation in those healthcare properties, and something that I definitely look at. I own the shares, bought the shares recently on a big drop in the stock, and I'm holding it for long term.
Okay, that's great. Yeah, I think people should take a look at it. That's very good information, and it's something that you've invested in it, and it's something that's interesting to you right now as an investment. So that's good to know. We could talk about this for hours because this is our favorite topic, right? Investing and dividends. But I think we're got to respect our time here for both of us. So, Joseph, where can people find you online?
Sure. Well, I'd love for people to come by the channel. That's Let's Talk Money. They're on YouTube. Love to see people join the community and leave a comment, ask me anything. I always try to respond to as many comments as I can. And just love for people to stop by the channel. Okay.
And you've got a blog as well, right?
Yes.
Put the links down. What's the blog name?
The blog is My Stock Market Basics. I don't post there as often as I used to, or as often as I should. It's really the YouTube channel. It's hard to get away from that direct connection with people, that face-to-face kind of connection you get in the sense of community with YouTube. So don't do a whole lot of blogging anymore, but just mainly sticking with my YouTube community.
Okay, so everybody go check out the channel. Joseph's got a lot of videos in there. Fantastic, lots of educational content. You're going to learn a lot, so definitely go check that out. Joseph, thank you so much today for sharing your knowledge, your insight with all of us today. I really appreciate it.
My pleasure. Thank you.